Welcome to Module 4 of the Credit Strategies Reading in Fixed Income. This short module looks at a couple of risks that come hand in hand with credit risk, that being liquidity risk and tail risk. So first up, we're going to look at liquidity risk. Liquidity risk, of course, is the risk that we can't trade in our securities very easily without offering a significant concession to the other side. So liquidity risk is all about whether there's decent volumes going through in the market that you can participate in. If there's not, then there may well be issues in trading. Now, generally in fixed income, liquidity is lower than in listed equity markets, but of course within fixed income you do get some very liquid securities. The most recent issue, that's what we mean by on the run securities, the most recent issue for a particular maturity, most recent bond issue for a particular maturity for sovereign nations in developed markets, they're likely to be very liquid indeed. But however, as we move into credit risky markets, corporate markets, and we find smaller issues, and maybe we look at particularly for off-the-run issues in these markets, we're going to find that liquidity can dry up and it can be quite difficult to trade. So maybe investors should use liquid on-the-run securities for short-term strategies. That's what ST stands for here, short-term strategies where we need to trade in the short term. Maybe we can use less liquid off-the-run corporate securities for longer-term strategies. Indeed, maybe if we've got the time, we can earn a liquidity premium, an extra return for the lack of liquidity of an instrument through holding it over the long term. Another thing we could do, of course, is use derivatives, an overlay strategy, either a derivative like a CDS, which we'll talk about later on in this reading, or ETFs which are really listed shares in a fund that holds potentially illiquid underlying bonds. Maybe trading in these ETFs is going to be easier than trading in the underlying bonds. And similar story with CDSs. Maybe the liquidity in the CDSs, the credit default swaps, is going to be higher than liquidity in the underlying bonds that the derivatives reference. Now, one measure for liquidity in fixed income, well, in any market really, is the effective spread. This is something actually that's covered in more depth in the trading and execution section of the level 3 curriculum. So my advice would be to park this, to just briefly acknowledge this, but deal with it properly when we get into trading and execution. The general idea with effective spread is that when you approach a market, there's likely to be, well, there should be a bid where another market participant is willing to buy, and there should be an offer or an ask, I'll call it an offer, where another participant is willing to sell. So you go into this market and you think, well, I could sell to that bid, I could sell low here, or I could buy high here. I could buy from somebody that's offering the shares, or in this case, the bonds. Whether it's a dealer center, a dealer-centric market, in other words, dealers are offering quotes, or whether it's an exchange where buyers and sellers come together directly and bid on the exchange, you will find that when you approach the market, there will be this market spread, this bid and offer, which will imply a mid-quote. Mid-quote is in the middle, and that's where everyone would trade if there was perfect liquidity at the mid-quote. All the buyers would buy here and all the sellers would sell here, and that would be great. But chances are, if you're a buyer, for example, you're actually going to have to pay up for the shares. So if you're a buyer, you're going to have to go over here somewhere, hopefully not all the way to the offer. If we're in dealer markets, dealer-driven markets, then actually, that offer is the least that a dealer will do for you in terms of you wanting to buy and them selling to you. Chances are that they'll improve on that offer. Well, let's say that you actually trade here. This is where you execute. So this is your trade price as a buyer. Well, the cost of your liquidity is actually this distance here, how far you had to go above the mid-quote to get your trade done. And that's what this effective spread is measuring. How far we have to go above the mid-quote to get our trade done, scaled up by the trade size. Similarly, the effective spread on the sell side is how far we need to go below the mid-quote to get our trade done. Okay. But like I say, actually this idea of effective spread has gone into in more depth and is most likely to be, if you like, if the examiner is going to interrogate you on this, it's more likely to be on the material in the trading and execution section where this idea is covered properly. Okay, let's have a little think about tail risk now. Tail risk is the risk that something adverse happens in markets, something infrequent. We're talking about crashes here, or significant market adjustments, market corrections. Tail risk is the risk that we find ourselves in the left-hand tail of a return distribution. So this might be a return distribution. That's what we think our returns are going to do. And tail risk really is the risk that we find ourselves in this tail, where we have extreme but unlikely losses. So infrequent but high negative impact events. Now, one way of measuring our tail risk, or beginning to talk about really our tail risk exposure, is to use value at risk. Value at risk is a tool which tells us our loss at a certain threshold in a distribution of returns. So for example, if there's 5% of returns expected in this tail here, and therefore 95% of returns are actually greater than that, your loss here, at this level here, that should point exactly to there, your loss here, where 5% of losses are equal to this or worse, that is your 5% value at risk, okay? So your 5% value at risk is the loss at that threshold, okay? Where 5% of returns are that loss or worse, and 95% of returns are actually better than that. Okay, that's your 5% value at risk right there. Look at the name of it. The name, people often kind of look at something and then look away, but look at the name, value at risk. It's the value that you've got at the moment that is at risk with a certain level of probability. There's a 5% chance you could lose this. This is for a period as well. Whatever the periodicity of these returns is in this distribution, it could be daily, could be monthly, could be weekly. What we're saying is, if this loss here is a certain amount, that is your value at risk over that time frame at the 5% level. There's a 5% chance you could suffer that loss or worse. So it's a measure of unexpected loss over a given time frame with specified probability. In other words, we don't really expect to be in this tail. There's only a 5% chance we are there, but if we are there, we're going to lose this amount or more. So for example, if the 1% daily VAR of a portfolio is $7 million, you know that there's a 1% chance that you could lose $7 million or more, all right? But actually there's a nice big fat 99% chance, we call that the confidence level. The area in the tail we call the significance level, all right? 99% chance, the confidence level, that you won't lose that $7 million, all right? You'll do better than that, okay? You might, you might make money as well, okay? The significance level, sometimes referred to as the error because we're in the tail. It's not the likely thing to happen. You need to think of the VAR as the loss that you suffer at that significance level, and then obviously there's a 1% chance you could suffer that loss or worse. The one of these that's framed positively, of course, is this one. You're very, very confident that you will not suffer that loss, essentially. All right, now tail risk technically deals with our losses in the tail, all right? And yes, it's controversial. VAR tells you where the tail begins. Tail risk and tail risk analysis deals with what happens when we get into the tail. And we can explore this through stress testing, scenario analysis. Through these tools, we can think about what factors push us into the tail and what, how likely those factors are to go against us, if you like. Things like spreads and volatility and equity market prices. I guess the $1 trillion question here is how did we get this distribution of returns? Because this idea of value at risk and tail analysis all resides on this distribution of returns. How did we get that? So there's three methods of getting to this distribution of returns. Okay, and they are what are discussed next. There's the parametric method, number 1, the historical simulation method, method 2, and Monte Carlo, method 3. Okay, so let's make sure we know what these are. The parametric method of generating that distribution of returns, look at the name, parametric. We're going to use parameters of an assumed distribution, usually the normal distribution. So if we assume our returns are normally distributed, all right, so we've got that classic bell curve, what we can do is use the parameters of the normal distribution and say, I now know that if you start at the mean and go left by a certain number of standard deviations, what we often refer to as a Z value, a certain number of standard deviations, then I can isolate a certain, through the properties of the normal distribution, I know what my area in the tail is. So for example, if I wanted to isolate 5% in the tail, my Z value, the number of standard deviations I need to go to the left of the mean, is 1.65. That's what this is telling you. And at that point, we know there's a 5% chance we suffer that loss or worse. So this level here, once again, that should point to that threshold. This level here is your 5% VAR. All right. Your loss at that level is your 5% VAR. And there's a 5% chance you lose that or more. There's actually a 95% chance you do not suffer that loss in the time frame that you're analysing. The historical simulation method is a little bit more practical and empirical. It just says, let's go back, say, for 1,000 days and think about the returns, or think about movements in key risk factors. All right. And what we can do is then apply each of these 1,000 days. I'm assuming we're working in daily time frame. Apply each of these 1,000 days to our current portfolio exposure. Might be thinking about our spread duration, that sort of thing. And see what happens if spreads move like that tomorrow. So that would give us, across all of our, if we did our risk factors together, representing the last 1,000 days, that will give us 1,000 potential days that could happen tomorrow based on the last 1,000 historical days. What we can do is then rank them. Now you've got the best ones at the top, best days, and the worst days at the bottom. And then you can pick off the bottom 5% of days. Each of these days is based on a day that's happened in the last 1,000 days, approximately 3 years-ish, or probably a bit more if we're thinking about trading days. We can pick the 5th percentile from the bottom, and that represents our 5% VAR. If we've got 1,000 days, the 5th percentile from the bottom is the 50th ranking outcome, the 50th from bottom, the 50th from worst, and so that would be our 5% VAR. That's the loss we expect to experience tomorrow, if we're doing this on a daily basis. All right, that's the loss we expect to experience. There's a 5% chance we experience that or a worse loss tomorrow based on historical days. Of course, the problem with this method is the future may not be like any of the past 1,000 days. There might be a black swan that we haven't seen before. But the good news is that we're not relying on distributions here. We're not assuming the world is normal. Incidentally, with credit, assuming the world is normal is a disaster. Credit, most of the time you get paid back, but every now and then you suffer a big loss. And so credit is negatively skewed and nothing like a normal distribution. So good luck with assuming things are relatively normal. That's what credit tends to look like. Historical might give you a better flavour, as long as you would want your last 1,000 days to capture the impact of some pretty stressful conditions, wouldn't you? Like a pandemic or a credit crunch, that sort of thing. In order that you don't get surprised by that when you think about what tomorrow could bring. Okay, the third method for generating that distribution is probably the most flexible method, but also probably the most sophisticated and complex one as well. Monte Carlo, you can really model your risk factors as random processes, how they change over time, how they interrelate. You can model all of that and think about what paths the factors could move down and what that means for your portfolio, what path your portfolio is likely to move down. Maybe your portfolio could, one iteration, maybe it does this. You could then rerun a simulation according to your assumptions. This can be nice and dynamic, change depending on which path you go down. You could incorporate rebalancing in here. You could incorporate changes in correlations as things get worse and so on. So a very flexible, very powerful, very, very powerful approach. And what you could do is model, if you assume a kind of a vertical distribution here, you could say most of the time we're ending up in here. Every now and then we have a good result, we end up there, and then the tail is down here. Sometimes we end up down there. And what you can do therefore is look at this distribution, look at where the bottom 5% occurs, and think that this here would be your 5% VAR over this time frame, the fifth percentile worst outcome, because that's really what it is, isn't it? Technically, it's the loss associated with moving to this threshold in your distribution. So yes, very flexible, doesn't assume normality, doesn't rely on the past, but of course you've got to get your model right here. There's high model risk, and it's quite, it's going to be quite expensive to maintain and build this model. It takes quite a lot of modelling power. So the drawbacks of VAR as a tail risk measure, VAR is like the gate to your tail. It's the threshold where your tail begins, and as such, it doesn't really tell you what happens in the tail. In fact, there's a whole branch of risk analysis associated with tail risk that goes beyond VAR. And the problem really with VAR is that it tells you where things get really hairy, if you like. But it does assume that this distribution holds when we're in the tail. Of course, when the market is crashing, people change their behaviour. When people just need liquidity, they just run out and sell whatever's liquid. And also, that means everything tends to crash at the same time. Correlations tend to pick up in the tail, which might affect this distribution for your portfolio that you are assuming. Not necessarily under Monte Carlo so much, as long as you can model it, but the other ones certainly. So VAR is not a perfect measure. If you want to interrogate the tail a little bit more and go beyond VAR, you could look at conditional VAR. Conditional VAR looks at your expected loss beyond your VAR. In other words, conditional on you being in the tail, conditional on you experiencing a tail event. So it's the average loss in the tail of the distribution. If you were to imagine there were two distributions, one relatively normal like this one, the 5% VAR might be here, because that's where the 5th percentile of the distribution sits. There might be another distribution that looks like this, which is very different, but it's got the same, there's 5% under the tail sort of here. It's got the same 5% VAR. There's 5% to the left of the tail here, to the left of that threshold here. But it's going to have a very different conditional VAR. The conditional VAR for the first one would be the centre of gravity of the tail. Where would you pick it up? I'd put my hand here, somewhere like that. That would be the C-VAR. C-VAR for this one, where would you put your hand to pick it up? I'd pick it up here. So the C-VAR is going to be very different, and really it's just reflecting the different shapes of the left-hand tail. So, the VARs are the same because 5% of distribution occurs to the left of the same point here, but the C-VARs are different because the shape of the tails are different. Okay, incremental VAR, as the name suggests, that's another extension of VAR where you're looking at the impact on your portfolio's VAR of adding or removing a position in the portfolio. And relative VAR is looking at the value at risk, so a loss at a given threshold of the relative returns of a portfolio to a benchmark. In other words, we're looking at what is the 5th percentile of the return distribution of RP minus RB, essentially. All right, gives us an idea of how far we could underperform the benchmark, when we're having a significantly negative event. Okay, that concludes Module 4 of the Credit Strategies reading in Fixed Income.